Hi there, Eric Blake, host of the Simply Retirement podcast. Before we get to today's episode, I wanted to share a quick heads up about an important live webinar we're hosting on Tuesday, August 26th at 6:30 p.m. Central. It's all about the new tax law, officially called the One Big Beautiful Bill Act. And it's already changing how your retirement income, Social Security, Medicare premiums, and even estate plans could get taxed. We'll cover what's permanent, what's temporary, and what smart retirees, especially women over 55, should be doing this year to make the most of these new rules. It's completely free. I'd love for you to join us. Just go to blakewealthmanagement.com/OBBBA. That's OBBBA to learn more and save your spot. Now let's get into today's episode. What does the new tax law mean for your retirement? Today, we're unpacking the most important changes from the One Big Beautiful Bill Act that could impact your retirement. Welcome to another episode of the Simply Retirement Podcast, where we want to empower and educate women to live your retirement on your terms. I'm your host, Eric Blake, practicing retirement planner with over 25 years of experience, founder of Blake Wealth Management, and I would not be the man I am today without the women in my life. This week, we're talking about the Big Beautiful Bill Act, or the One Big Beautiful Bill Act. I got to get all that in there. The newest tax law, and again, most importantly, how it impacts your retirement. Joining me again on this episode is Wendy McConnell. Wendy, how are you?
Good. I thought you were referring to me as you wouldn't be the man you are without me, and then you were like,
That is absolutely true. You're Hey, I've got so many great women in my life, and you're one of them. So don't sell yourself short.
Shucks, thanks so much.
So as I thought about this, and I don't know if maybe I'm the only one that thinks this will be funny, but so I had my first root canal on Monday ever, my first root canal. And I'm sitting there thinking about, okay, this is probably what Wendy thinks about. This is what Wendy thinks when I'm talking about taxes is this has got to be like sitting through a root canal.
No, it's not that bad.
And what was funny is that, so the dentist, I kind of compare myself to the dentist in this scenario. He's like, and this has been going on for a while, so it's finally time that I got this done. And he was talking about, how much it was bleeding, and he starts making jokes, like maybe like what I would make about taxes. He's making jokes about, well, but we had to keep sucking out, otherwise you would have bled out.
Oh my!
That's not a good joke.
Yeah, that's not funny.
That is not a good joke.
A dentist with a sense of humor. That's rare, though.
But it was kind of a dry the way he said it too. So I don't know how funny he was trying to be funny, but I'm like, I'm laying here with my mouth open and you've got all these tools going in and out. I'm like, don't use the bleed out. Come up with something else.
All right. Well, I'm glad you made it through that.
I did. And much better on the other side. So again, you got to fight through the tax issues and learn about what's going on. And then on the other side, hopefully you're coming out better. So that's what we're going to do today.
So in about 25 minutes, we're going to be on the other side, right?
Hopefully so. I want to get through this relatively quickly. I want to get through the key provisions that impact retirement planning primarily, and then talk about some planning strategies that you want to be aware of. And as always, just want to make sure when we're talking about taxes, tax planning, be sure to consult your tax advisor, your financial advisor, to understand how these provisions apply to your specific situation. Sound good? Awesome. Well, let's hop into this. So first thing I want to do is just kind of set the stage. So with this new bill, basically what it's doing is, depending on how you want to describe it, it's either modifying, extending, replacing the Tax Cuts and Jobs Act. So one of the things to think about with that, so the Tax Cuts and Jobs Act was signed in 2017, went into effect in 2018. And it was set to expire, basically come to an end at the end of this year, at the end of 2025. In which case the current tax rates, the deductions, all these different provisions we've had in place for the last several years would have ended, and we would have reverted back to what we had in 2016. So that means higher tax rates we had in 2016. So 22% tax bracket would have gone to the 25, the 12 would have gone to the 15, and so on and so forth. But this new law is going to preserve and expand, in many cases, some of these different tax benefits for retirees. And that's really what I want to break down, is how these are going to impact you, what to be aware of. Again, you may not need to know all this, but you need to ask the right questions. And that's what we're hoping to accomplish today.
Okay.
The other thing to be aware of is a number of these provisions are temporary. So the Tax Cuts and Jobs Act was set to completely expire at the end of this year. There are provisions in the new tax code that have been we'll call it quote unquote permanent for our purposes, but there are some very important provisions that are going to be temporary, that will expire at some point here in the next few years. We're going to point those out as well and talk about, again, planning opportunities where you can take advantage of some of these different new benefits.
So things are going to stay the same, change, and it's very confusing. So you're going to help weed through it.
Hopefully we're going to clarify and make it at least as clear as mud. If nothing else, right? So let's talk about the tax rates, right? So that's the first thing. So I think it is important to understand this. So there's basically 7 tax rates when you're talking about filing single or filing jointly. There's the 10, the 12, the 22, the 24, the 32, the 35, and the highest tax bracket being 37. So those are what changed with the Tax Cuts and Jobs Act. And again, they were temporary. They were going to sunset at the end of this year. They were going to go become higher. So again, this new tax law basically locks those in. They are now quote unquote permanent as a tax law can actually be, which means in the next 4 years, they could change again.
Okay.
So it's important to be, when we say permanent, it is always in quotes. So you got to be aware of that. But for now, these have been made permanent. So these are going to be in place for a while at least. And what that does is it gives us at least some level of predictability, some stability that helps support better planning for retirement income. So when you're thinking about, Roth conversions and you're thinking about Social Security decisions, any income source that is connected to ordinary income tax rates, at least we know, okay, for the next few years, quote unquote permanent, these tax rates are going to be in place for at least for a while. So at least we can look over the next handful of years and say, okay, here's what we're looking at. Here's where our decision points within these different tax brackets. Does that make sense?
Yeah.
To some extent.
Yeah. Okay.
So the tax rates we've had since 2018 are staying the same. They're not going to be changed. They're not going higher. That's the bottom
line. So that's
line.
not changing anytime soon.
That is not changing anytime soon. They are quote unquote permanent.
Okay. Gotcha.
The next one is going to be the big one. All right. So this is it's a $6,000 bonus deduction for individuals 65 and over. And that's going to be a key, 65 and over. Now it is a $6,000 deduction per qualifying individual. So if we're talking about a married couple, that could be $12,000 total if both are 65 and over.
Okay.
Now this is actually going to be retroactive to 2025. So if you're by the end of this year, by December 31st, if you're going to be 65 years old, you're going to be eligible for this deduction. Now, here's a couple of the other key things to be aware of. This is above the standard deduction, or if you happen to itemize, you're going to get this deduction on top of all that.
Okay.
Right? So that's truly an additional amount, a truly additional deduction above your itemized deductions or your standard deduction, depending on which of those applied to you. So if you had enough interest on your mortgage, or you had property taxes, charitable donations, different things like that. If all that added up to be more than the standard deduction so that you could itemize, this is going to be above that. So That's important to keep in mind. So this is basically, we'll go back and try to keep the political aspects of this out of the equation as best we can. But this is basically the response to Social Security taxation. This was basically a provision that was helped to create less taxation on Social Security. That's really what this came down to.
Okay.
Right. And I'll touch on Social Security a little bit more in detail here in just a bit.
Okay. So what is the standard deduction?
So great question. And because the standard deduction has actually changed, it's actually gone up a little bit from what it was supposed to be prior to the new tax law. So for a married couple, married filing jointly, the basic standard deduction is $31,500.
Okay.
If you're over 65 currently, and you're taking the standard deduction, you get an additional $1,600 each. So potentially an additional $3,200. Again, that age 65 is critical. For a single filer, the standard deduction is $15,750.
You're losing me here. Okay. You said that it was a $6,000 deduction.
Forget about the $6,000 for just a moment.
Okay.
So let's do this.
All right.
So that's a bonus deduction. Think of that as just a bonus deduction.
So we haven't even gotten to that yet.
Not even gotten to that yet. So the standard deduction, so this is across the board. Anybody, married couple, it doesn't matter how old you are, $31,500 if you're a married couple filing jointly, right? Doesn't matter of age. Then we have the single standard deduction is $15,750. Again, doesn't matter how old you are.
Okay.
Now, for our audience, I want to point out that the 65 plus, an additional standard deduction that you've been getting, this has been available prior to the new tax law. This is part of the Tax Cuts and Jobs Act. Over 65, you get an additional $1,600 per individual, $3,200 for a couple. Okay, that's married filing jointly. For a single filer, in addition to the $15,750, you get an additional $2,000.
Okay.
Standard deduction. So again, these are all standard deduction items. We'll come back to the bonus deduction here in a minute. Those are standard. That's the standard deduction. So if you don't have enough property taxes, you don't have enough state income taxes, you don't have enough interest on your mortgage, you don't have enough charitable donations. So all those things added up, potentially, if it's more than those numbers I just gave you, then you might be able to itemize your deductions. Okay. Over 90% of Americans don't itemize because they don't have enough of all those items because the standard deduction is so high.
Right.
Right. So now with the new tax law, above those items, whether you itemize or you take the standard deduction, now if you're 65 and older, you get this additional $6,000 bonus deduction. Okay. So again, married couple, if both couples are over 65 by December 31st or 65 or older by the end of December 31st, an additional $6,000 each, $12,000 total.
So, in addition to, say, the 31,500 and then the additional, I forget how much.
3,200 for a couple. If both couples are over 65, an additional standard deduction of $3,200 total for that couple.
I was just under the impression that the standard deduction meant that you deduct that from the income. Like if I made $90,000, then I take the standard income and it's like 61 or whatever. And then that's the amount that I pay taxes on. That's not how it works.
Okay. Yeah, no, it is. I think I understand. Maybe I misinterpreted your question.
Okay.
So basically when you think about the tax, think about what your tax return looks like. You've got gross income.
Mm-hmm.
You've got what are called above the line deductions. So if you happen to be working, you might be able to make an IRA contribution as an example. So if you make, let's use round numbers, $100,000. I made an IRA contribution of $8,000 because I'm over 50. Well, that then gets subtracted from your gross incomes, and that makes my adjusted gross income, my AGI, $92,000. Then I subtract my deductions from that.
Right.
And again, we're just keeping this very basic. So I subtract whatever my deduction amount is. So if I'm taking the standard deduction and I'm a married couple, let's say I'm 60 years old, the standard deduction is $31,500. So I take my $92,000 after my IRA contribution, and then I subtract my standard deduction to get my taxable income.
Got it. Yep, absolutely. So this is, the extra $12,000 is significant.
It is significant. Exactly. So that's when we say, okay, let's add that to the formula and say, okay, if we take $100,000, we make our IRA contribution, that gets us to 92. We subtract our standard deduction, our basic standard deduction of $31,500. Well, if I'm over 65, if I'm taking the standard deduction, I get the additional $3,200 as a standard deduction. And on top of that, I get $6,000 per individual or $12,000 total for a couple. So that could be, again, as you said, it's a very significant impact there, right?
For sure.
And again, the big thing to keep in mind is this is not a permanent change. So it is retroactive to 2025, but it's only going to be in place until the end of 2028.
Okay. And then it just goes away.
Then it just goes away.
Okay.
But this is why it presents such an important planning opportunity, especially for couples and for individuals across the board. It presents an opportunity to say, okay, if I'm going to be in potentially a lower tax bracket, I'm going to have lower taxable income. Should I be thinking about some of these other planning strategies, tax planning strategies, whether that's, again, Roth conversions, things along those lines. So those are a couple of the key points. So again, must be 65 by December 31st, including 2025. If you're 65 by December 31st, 2025, you're going to be eligible for this deduction. Now, here's the tricky part. It is phased out based on your adjusted gross income. Okay?
Okay.
So let's try to explain this as best we can. So
I thought we went through the tricky part, but okay.
So let's use our example that we came up with. So we said $100,000 income, using an $8,000 IRA contribution because I'm still working. Maybe I got some self-employment income, whatever it might be. The phase-out range for this deduction for a single filer is between $75,000 and $175,000.
Oh, okay. Gotcha.
So I have to be less than $75,000 in income to qualify for the full deduction.
Okay.
For a married couple, married filing jointly, the income range is $150,000 to $250,000. So I have to have adjusted gross income less than $150,000 to get that full deduction for both spouses.
For the 6,000 each.
Yes.
Okay,
Yes.
gotcha.
If you're above that bottom number, so for a single filer, if you're above 75,000, you can still get part of it, but it's going to start getting reduced. So the $6,000 is going to get reduced until if you're at 175,000, zero. So you lose the deduction altogether. If your adjusted gross income is 175,000 or more. For a married couple, if you're more than 150, so if you're less than 150,000, you get the full deduction for both couples or for both spouses. If you're above 150,000, it starts to get reduced. You still get a part of the reduction, but it's going to start getting reduced until you have 250,000, in which case it's eliminated altogether. Make sense? So use it back to our example. Let's say we got $100,000 in income. We'll do a married filing jointly first. $100,000, $8,000 IRA contribution gets us to $92,000. That means I'm below the 150, right? So both spouses are eligible for the full $6,000 deduction, $12,000 total.
Mm-hmm.
Now let's talk about that single individual.
Mm-hmm.
75,000 is that lower limit. So if I have $92,000 in adjusted gross income and that lower income is 75, I'm starting to lose part of that $6,000.
Okay. Not all of it.
Not all of it until I hit 175. So I'm still going to get part of it, most likely the majority of it, but it is going to be less than $6,000. So this is where the planning and doing tax projections really becomes critical when we're talking about the impact of these changes going forward for the next 4 years.
I got it.
Got it?
Next. I'm ready.
All right. So, and again, I wanted to point that out because our example actually ends up tying to something I want to talk about here in a little bit, and that's the widow's penalty and how that potentially plays into this equation as well. When you lose a spouse, what are some of the potential tax implications? All right, so let's talk about Social Security now. So actually, one of the campaign promises that Trump had was ideally zero tax on Social Security. But based on actually the way the laws are written, that wasn't really possible. So this is basically the compromise, was this additional $6,000 deduction for age 65 plus.
Okay.
So the way the math actually worked and what you're seeing in the news is that the law basically results in somewhere around 88-90% of beneficiaries of Social Security beneficiaries recipients not paying tax on their Social Security. So somewhere between 88-90% of Social Security recipients won't be paying tax on Social Security.
Okay.
That's not everybody. So you want to be aware of that. And that's one of the things that I think there was an email, basically a press release that went out from the Social Security Administration saying, hey, we applaud the decision, the tax law is in place, and X number of people won't be paying tax on Social Security. Well, that got interpreted as Social Security is now tax-free, which was not the case, right? But that did create a lot of confusion, a lot of frustration, of course, as well as you might expect. But again, it's a key to remember that it is basically the taxation on Social Security hasn't really changed. And I'll refer our audience to our episode 54, where we actually talked about how Social Security gets taxed, because the provisions, all that, the provisional income thresholds, all those things we talked about in that episode have not changed. It's just that now we have this additional bonus deduction that might help, right? So just want to clear up the confusion on Social Security specifically around how that impacts. So again, less people will be paying tax on Social Security, but it's as a result of that bonus age 65 deduction, not because Social Security is now tax-free.
I understand.
So then talking about, I talked about just a second ago, the widow's penalty. So I think that's one of the things that you want to think about. And it's not so much that widows are going to get impacted more than anybody else necessarily. But if you think about just the example that we gave, so just kind of stepping back and saying, okay, what is the widow's penalty? Basically, it is a spouse passes away, the surviving spouse may lose a Social Security benefit, but especially if you have larger IRA balances, if your total income may not change, even though you might lose one Social Security benefit, your income may not change a whole lot. But if your income doesn't change a whole lot and you're a single filer, you can see how you might end up in a higher tax bracket. So basically, very similar income, one less spouse could push you in a higher tax bracket very easily.
Okay.
Especially we're talking about this deduction that I talked about. Just that small difference in a $90,000 income between a married filing jointly being eligible, both the spouses being eligible for that deduction, versus a single filer at $90,000 losing part of that deduction.
Okay.
So that's really where, if you're looking over the next few years, especially if you are married, and anybody needs to be looking at this, but if you're married and you have concerns about, okay, what would happen if one of the spouses passes away? What are things we could be doing proactively with these new tax laws to reduce the impact of that future widow penalty?
Makes sense.
So we start talking about things like, again, Roth conversions. If you're going to have lower taxable income, should we be thinking about Roth conversions? How should it impact our Social Security decision? So if you're talking about Social Security recipients and 88 to 90% of them not paying tax on their Social Security as a result of the deduction, well, you don't get the deduction until you're over 65. So does that change your decision around filing early? Should you reconsider filing at 62 or 63 or 64? Or should you think about, how would I prioritize my income sources if I do retire?
Mm-hmm.
Which sources should I be taking from first? And does it make sense to now delay Social Security even further? Number one, to take advantage of this new tax benefit, but also to grow the survivor benefit for the surviving spouse. So this may give you a little bit more flexibility to do some of this planning that really could be impactful down the road.
Okay.
All right. Another pretty impactful provision. It's not going to impact everybody, but we just talked about the difference between the standard deduction and the itemized deduction. One of the things that has also changed is what's called the SALT cap, the state and local tax deduction amount, right? So for the last several years, part of the Tax Cuts and Jobs Act is that it was capped at $10,000. So thinking about your state income taxes, your property taxes, those types of things primarily. So if you had $15,000 between property taxes and state income taxes, if you had $15,000 that you paid in both of those categories, you could only deduct up to $10,000.
Okay.
Right? Well, that's changed. Now it's going to be $40,000. So if you're in a state that has high property taxes, like we're here in Texas, or it has high state income taxes, like in California or New York, or both, there's a few states out there that have both. This is going to be a pretty significant tax benefit here, potentially. And again, you have to be itemizing your deductions. But even just yesterday, I had a conversation with a client where we were reviewing. She had that $10,000 on her tax return. And so he said, well, let's look at what your total property tax and total state income tax was, because if assuming it's a higher than that, you're going to actually get the benefit from that. So if she continues itemizing, which she will, it's in her case, it wasn't a whole lot, but it's about $1,000 extra in property taxes that she wasn't able to deduct last year, that this year she'll be able to.
Yeah. Every little bit helps.
Absolutely. So it makes a pretty significant difference, because she gives a good amount to her church. So she ties every couple of weeks. So when you start adding all this stuff up and say, okay, an extra $1,000, if you're in the 24% tax bracket, that's a couple $100, right? So again, it all adds up. So that's another, and again, that's also one that's going to be temporary. So that applies from 2025 to 2029, and then it goes back to the $10,000 cap. So it's something to be aware of. So again, thinking proactively over these next few years, what can I do to have a pretty significant impact on my tax situation, really for the rest of my life?
Yep. Do all that we can.
Do all that we can. So now I'm going to touch on a few more planning topics, and then we'll move into some strategies. Charitable giving. Again, a lot of people do give to charity. There's been some different changes there. Starting in 2026, if you don't itemize your taxes, meaning you didn't get a tax benefit for any charitable donations you might have been making, you now will get a $1,000 deduction for a single filer and a $2,000 deduction for a joint filer. So this is very similar to what they did during the COVID time, where if you didn't itemize, they were encouraging people to still make charitable donations in those circumstances. So even if you take the standard deduction, you get an additional $1,000 for single filer and $2,000 for joint, if you're giving enough, of course, to qualify for that. Now, the other one for itemizers related to charitable giving, there's now a floor, very similar to the medical deduction. So if you have to have above 0.5% of your AGI. So using the easy $100,000 number we were using before. So you have to have at least $500 in charitable donations before you get to include that in your deductions, right? So just a couple of small items there. The estate tax exemption, again, this really only applies to really high net worth couples and individuals. That is now where it was potentially going to get cut in half. So this year it's around 14 million or so. It was potentially going to get cut to about 7 million in 2026. That exemption amount has now been made permanent and will also continue to increase. So next year it's going to be like $15 million and 30 million for a couple.
Whew,
so
thank goodness. I was really worried about that.
There are people out there who have to worry about that. We've got a couple of clients we have to deal with on that, but
very nice.
For the most part, impacts very few people, but if you think it does, again, talk to your estate planning attorney, talk to your financial advisor, your tax advisor, all that fun stuff. Last one I'll touch on is the auto loan interest deduction. So this is something very new where if you purchase a car made here in the United States, you could potentially get a deduction, an additional tax deduction on the interest for that auto loan. So again, something to keep in mind if you happen to be in that particular situation. So those are really the key provisions from a tax planning standpoint. So I want to talk about some strategies that you may want to think about, again, over these next few years while we've really got some opportunities here. I think one of the things I would stress is that we talk about with our clients every year, the advantage we have over Uncle Sam is that we can look many years in advance. We can look over the next 5 and 10 years and think about what are the strategies we're going to be able to utilize versus Uncle Sam basically just looking 1 year at a time. So all Uncle Sam cares about is 2025 and then next year, 2026. We want to start looking at 2025, 2026, 2027, and so on, and seeing, okay, what are these things we're going to be able to implement over these next few years as we have these new tax planning opportunities in order to reduce our lifetime tax liability. So that's really where these strategies are going to come into place. So the first one is, again, if you have not yet filed for Social Security, you might want to reevaluate your filing strategy. If you're going to become eligible here in the next few years, think about whether I should delay a little bit longer. Am I going to be able to take advantage of that new tax deduction, the $6,000 age 65 deduction? How would that change my decision around Social Security, whether I'm going to file at 62 or 65 or try to delay it farther till full retirement age, if that happens to be 67 or even as long as 70. So reevaluate your Social Security filing strategy is going to be really important right now. Things like Roth conversions, looking over the next few years. So thinking about Roth conversions. So think about what this is. Basically, strategically, we're going to choose to take money out of our pre-tax accounts and convert those to our tax-free buckets, our Roth accounts, based on taking advantage of maybe being in a lower tax bracket, especially with, again, this new $6,000 bonus deduction.
Right.
Now, again, you got to be careful about it. As we talked about, there are income thresholds that if you push yourself too high, you might actually lose some of those deductions. So that's where doing those tax projections really becomes important. We talked about charitable giving earlier, also thinking about ways that you can strategically give to charities that have a tax benefit. So there's something called a qualified charitable distribution where you can take required amounts. If you have to take required distributions from your retirement accounts, you can actually have those sent directly to a charity and avoid paying taxes on those dollars yourself. So again, if you happen to find yourself in saying, hey, I'm a little bit above that threshold for getting that $6,000 deduction, what if I say, hey, maybe I'm going to just send part of my required distribution to a charity and bring my income back down below that threshold?
Oh, yeah. And then it's good for both. Yeah,
exactly. And it's always wanted, we don't want to give to charities simply for tax benefits, but if you can get it,
right,
we don't want to lose it either. Again, it's
right.
you always talk about, we don't want to give Uncle Sam a tip. We'll pay our fair share. We just don't want to give Uncle Sam a tip.
Right. Yeah. Exactly.
So again, definitely consider qualified charitable distributions, bunching, what we call tax deduction bunching. So paying your property tax. Now that we've got this higher SALT cap, does it make sense again, like it used to a few years ago, of paying multiple years of property taxes in the same year? So maybe I think about paying 2025 and 2026 in the same year in order to take advantage of that higher itemized deduction amount. So think about some of these strategies to take advantage of these higher limits that are available now. Let's see, tax harvesting. So there's something called, if you've never heard of it, it's called tax loss harvesting. So if I've got a loss in a particular investment that I have, I can sell that asset at a loss and be able to reduce my taxable income in the current year by up to $3,000. And if it's more than $3,000, I can carry it forward. So it's a loss carry forward. Well, now with some of these new changes, you might actually think about what are called tax gain harvesting. Or maybe I've been sitting on a particular investment that has a pretty sizable gain, but now if I got this $12,000 deduction, maybe that gives me a little bit more room to take advantage of that, to say, hey, maybe I need to diversify my portfolio, but I've been hesitant to do it because it's going to cause some tax implications. So evaluating some of those additional opportunities as well, again, being in a lower tax bracket, could this present some opportunities to diversify my portfolio a little bit better or use some of that money that has some gains in there?
Yeah. Okay.
And again, big one is just evaluating your income planning strategies through 2028 while we have these deductions available. Again, our advantage over Uncle Sam, like I said, is to be able to look farther in advance and say the next 3 to 5 years, what are my opportunities? doing tax projection. Do a tax projection for this year, do it for the next year after that, and so on, and see where do I think I'm going to be, and where can I adjust income? Can I shift income to different years? All those types of strategies can really become impactful during this time period.
So planning is important.
Very important, yes. Yeah. And again, and that's really, again, you really need to do, again, I would always encourage you to working with a financial advisor, work with your tax professional to look at what these impacts could be on you. Because again, you only get certain opportunities. These types of opportunities only come around so often. So you got to think about how you're going to take advantage of those.
Okay.
Anything else that you think I'm going to clarify, or any other questions that you have before we wrap things up?
No, please. I mean, I could ask questions for days, you know that, but I think I got an overall understanding of how the benefits of this bill is going to impact.
I think ultimately it does. If you use the right strategies, it can have a positive impact. If you don't, if you kind of get caught off guard, it can have some significant negative impacts as well.
Again, going back to planning. Yeah.
Absolutely.
All right.
Well, Wendy, thank you so much for joining me in this conversation. Thank you to our audience for tuning in. If you're not sure how this new tax law is going to affect your retirement plan, this is the perfect time to take some action. So again, talk to your tax advisor, talk to your financial advisor to get some clarity on your specific situation. If you don't have a financial advisor who includes tax planning as part of what they do for you, or if you're just looking for a second opinion, you can visit getmysimplyretirementroadmap.com to learn more about our process for helping you make an educated and informed decision about our firm. That is it for today's episode. As a reminder, for all the links and resources mentioned today, visit the simplyretirementpodcast.com. Please don't forget to like, follow, and share our show. Until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
That's it for today's episode of the Simply Retirement Podcast. We hope you found our insights and advice helpful in planning for a fulfilling retirement. Don't forget to take action on what you've learned today. Visit our website at blakewealthmanagement.com to learn more about our firm and review our Simply Retirement Roadmap process to get you on the right path to the retirement you deserve. And don't forget to click the follow button to be notified when new episodes become available. Thank you for joining us on this journey, and we look forward to helping you achieve your retirement goals. Remember, retirement is not the end of the road. It is the start of a new journey. So embrace it and make the most of it. Until next time, take care. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor, Blake Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.